Okay, so in today's show, we're going to do a deep dive into the required minimum distributions, which are commonly referred to as RMDs. And I'm going to cover what is the RMD, what is the RBD, what types of accounts have an RMD, when do you have to take the first RMD and then subsequent RMDs, how have the RMD rules changed recently, how do you calculate the RMD, when do people take their RMDs? I'm going to look at the 3 different distribution tables the IRS has for calculating your RMD. We'll look at how the RMD has changed over time, why the RMD will be decreasing starting in year 2022, how might the RMD distribution change again based on some legislation that could be coming our way, what are after-tax contributions to an IRA and how are the RMDs impacted, and then how to avoid paying taxes on RMDs. And of course, I'll include some links to some popular calculators for calculating the RMDs and to help you with all of this in the show notes. And boy, I've put together just a ton of resources for you in the show notes. So if this is something you really want to learn more about and dive into, I've got it all in one place for you. Just visit soundretirementplanning.com, click on episode 353, and you'll enjoy all of the resources there. So one reason I wanted to do a show about required minimum distributions is because we're getting ready to release a new update in the retirement calculator that we've been developing. And over the years, this particular feature request has been one of the most commonly requested features, but it's also one that I've really shied away from including in the calculations for the retirement budget calculator. And the reason is because of the complexity around this topic. And so I think as we start to dig into this, you'll come to understand why I was reluctant to tackle RMDs within the calculator. But I think you're really going to love it for those of you that have already joined us over at the calculator. I would also caution you and remind you that RMDs can be very, very complicated, and you'll see that as we get in today's show. So if there's any question about your specific situation, I highly encourage you consult with somebody that can help you make sense of these complex rules. Okay. You can't keep money in your tax-deferred retirement accounts forever. Eventually, you must start taking distributions from these accounts, even if you don't need the money. For some people, this really rubs them the wrong way. I think this is the reason their skin crawls a little bit when we talk about RMDs, because people don't like being told that they're forced to have to do something. And that's what happens with an RMD. Even if you don't need the income to supplement your cash flow, you have to take money out and pay taxes at the time that you take those distributions. This additional income can often cause people to pay more money in taxes than they had originally expected. Many people think that their taxes will decrease in retirement. And while this may be true for some, I found that oftentimes people remain in the same tax bracket and many times find themselves paying higher taxes after their RMDs start. If you think about traditional retirement accounts such as a 401k, IRA, SEP IRA, or simple IRA, in most cases, the idea is you don't pay taxes now, but you pay taxes later. Another way of saying this is short-term gain, long-term pain. You get a tax deduction at the time you make the contribution. Your money grows tax deferred for years, and then you take the money out of the accounts in the future and pay taxes as ordinary income at the time of the distribution. Even if you don't need the income, you're required to take the money out or face steep penalties. So in today's podcast episode, we're just going to dive deep into this RMD and really help you make sense of it. Today's episode is really focused on the required minimum distribution, but the fact that the Roth IRAs do not have a required minimum distribution until after the death of the owner is another reason to consider trying to get as much money into the Roths as possible. The Roth IRA is the opposite of an IRA. You don't get any tax deduction for contributing to the Roth, but the money grows tax deferred, and as long as it's a qualified distribution, the money comes out tax-free. And this is what we call short-term pain, long-term gain. One of the best visualizations around this idea of IRA versus Roth IRA is the idea of the apple orchard. Imagine you're a farmer and you're starting an apple orchard, and you're given the opportunity by the IRS to pay taxes at the time that you plant the apple tree or the apple seed, So you get to pay taxes the one time when you plant the seed. Or instead of paying taxes on the seed, the IRS says you can wait and forego paying taxes on the seed now, but after the apple tree matures and you start to harvest every apple off of the tree, each of those apples will be taxable in the future. And so this analogy of the apple orchard is the Roth IRA is like paying taxes one time on the seed. The traditional IRA is like paying taxes on the harvest. Every time you pull an apple off the tree, you get taxed. So the question is, which one would you prefer? The required minimum distribution rules change from time to time. The latest change that occurred was in December 20th, 2019 under the SECURE Act, which stands for Setting Every Community Up for Retirement Enhancement. In today's show, we're going to do a deep dive on the way RMDs worked today, but you should be aware that there is another bit of legislation on the horizon called SECURE Act 2.0, which, if passed, will change the RMD rules again. For today's episode, we're focusing on how the RMDs work as of July 2021. This is subject to change, so if you're listening to this in the future, be sure to check on the most recent RMD rules. So what is the required minimum distribution? The required minimum distribution is the amount of money that you must withdraw or face IRS penalties. Your withdrawals will be included in your taxable income, except for any part of the withdrawal that was taxed before or that can be received tax-free, such as qualified distributions from a designated Roth account. Excess distributions in 1 year cannot be applied to the RMD of a future year. So let's say that your required minimum distribution was $40,000 this year, but for whatever reason, you end up taking $60,000 out. The additional $20,000 distribution this year cannot count towards next year's distribution. Required minimum distribution amounts cannot be rolled over into another tax-deferred account. Oftentimes people will ask, can they take the RMD and roll it into their Roth IRA? And the answer is no. What are after-tax contributions to an IRA? It's important to remember that anyone with earned income can contribute to a traditional IRA, but not every contribution is tax deductible. Depending on your income and access to a workplace retirement account will determine when you get phased out of a tax deduction for making contributions to an IRA. When you make a non-deductible contribution to an IRA, you must file Form 8606 to track your after-tax contributions. The cumulative after-tax contributions are called your basis. Because it's possible to have both contributions that were tax deductible as well as contributions that were after tax, then by tracking the basis, you can determine what part of the value of the IRA is pre-tax and post-tax. Future distributions will be taken out pro rata or proportionately. Having after-tax contributions still requires a required minimum distribution, but the taxation of the required minimum distribution will be determined by how much of the RMD is after-tax versus pre-tax. So when do you have to take your first required minimum distribution? You have to take your first RMD, which is known as the RBD, or required beginning date, by April 1st of the year after you reach age 72, or 70 and a half if you had reached 70 and a half before January 1st of 2020. Generally speaking, if you turn 72, you will take your RMD in the year that you turn 72. But in some instances, it might make sense to postpone taking your required minimum distribution until the following tax year. You must take your required minimum distribution by April 1st of the year following the year you turn 72. If, for example, let's say you're still working the year that you turn 72, but you're planning to retire, your income might be lower in the next tax year, and so you would want to time your first RMD to take advantage of the year when your wages will be less and hopefully your taxes will be lower. If you wait to take your first RMD until the following year, then you'll need to take 2 RMDs that calendar year. The first by April 1st and the second no later than December 31st of that year. After the required beginning date, all subsequent required minimum distributions must be taken by December 31st.